thank you everybody for joining us and welcome to today's webinar presentation, Economic and Market Update. Since Suzanne joined us last year, we're doing these quarterly, and it's just a good time to, check in on how the market is doing and what's happening in the economy, because it really does have an impact on the work that we do and how people feel and think about their financial plan. So here's a brief agenda. Today's webinar will start out with some introductions for Suzanne and myself, and just a few words about the firm. Then Suzanne will jump right in and talk about the economy and, kind of where we are today, check out our usual measures that output, unemployment, things like that she's looking at least a quarterly basis, and then just kind of a few comments on what's particularly interesting this quarter. And then we'll move over to investments and talk just a little bit about how these factors interplay with what's happening in the investment market, a little bit about returns and some discussion of trends. And then we'll open it up to Q&A. If you have a question as we go, feel free to type it into the chat or the Q&A, but we might not get to it until the very end section. All right, so with that, I'm Sarah Stanich. I'm founder of Cultivating Wealth. I'm also a financial planner and financial advisor, and certified financial planner and certified divorce financial analyst. And my most recent thing I'm doing is certified exit planning advisor, which is mainly for business owners. So if anybody is interested in learning more about that, let me know. I'm here in Montauk, New York, and all the way across the country, Suzanne is in Portland joining us. And Suzanne Hyatt is a chartered financial analyst and joined our firm last year and is an advisor working with clients, but is also kind of our resident investment specialist. Just a few words about the firm. So we're Cultivating Wealth. We're an SEC registered investment advisor. We meet with clients nationwide virtually. We were already doing it before COVID, but of course now, since last March, our meetings are 100% Zoom meetings, kind of like this. And what, I think in the services we offer, comprehensive financial planning, investment management, and we also have like a specialty business and divorce financial analysis. And what really sets us apart is that we're independent. We have 5 advisors, 5 employees working with us now, but that's, pretty small in the scheme of financial planning firms and investment advisors. We are also fee only, which means that we cannot accept any commissions, which I feel is a better structure for our clients and removes potential conflicts of interest, and we are a fiduciary. Just gonna point out the disclaimer. We have a compliance consultant. We always have to include these things, but these types of presentations are designed to be educational. They're not advice and should be, taken as investment, legal, or tax advice. If you would like to discuss your individual situation, of course, let's set up a meeting. Okay, so let's move over to Suzanne and tell us, how would you describe 2020 based on that picture?
So I love this picture. It's a T-shirt that actually my stepdaughter has. And I think it really captures the sentiment that a lot of people have expressed about 2020. But one thing I noticed is that it was a very different year depending on perspective and where individuals sat. So if you work in the tech industry, or for example, if you had a lot of Google stock, it was a very lucrative year. If you headed up a small chain of restaurants, it may have been an economic disaster. If you are in a position to isolate and socially distance and still stay employed, then it wasn't that bad. And so I don't need to read these to you, but basically there was a lot of difference depending on where one sat, one's personal circumstances, one's employment circumstances. One thing I've always kind of commented, I heard so much noise about the new year, and I, ever since I was a little kid, I've always sort of scratched my head and wondered, why is the transition from December 31st to January 1st such a big deal. I wake up the next morning and it looks the same to me, and it makes me a bit of a party pooper. But I think it sort of drives home the point that we entered 2021 in a pandemic with a struggling economy, and the magical change in the Gregorian calendar didn't make those things go away. We do have a new administration. We do have some vaccines that we're finally able to roll out. Those are the things that are going to make the big differences, I think, as we're able to support the economy or not. That's, I think, what's going to be more telling about what 2021 will look like. Hopefully, I will have a much happier graphic for presentations from now. So I put setting on the agenda, and the reason is I think it's difficult to even think about how we're going to see the economy move forward without thinking about the political climate in which we find ourselves. So I've got this map here by means of full disclosure. The little purple circle with the house is where I grew up. The little red circle with the star is our nation's capital, and the little 495s show you the Capital Beltway. So I grew up inside the Beltway, and we all have a certain perspective when you grow up that close. In my AP Government and History and Politics class, in high school, we got on the Metro, went down to the Supreme Court, and stood in line, and I got to watch Justice Antonin Scalia just chew on a lawyer for about an hour. And that left me with a certain reverence for the actual physical plant of our nation's federal government that I think probably skews my opinions about the recent events in a way that I just wanted to disclose. So that being said, one thing that is absolutely true, and I even took an entire course on this in graduate school, is that strong institutions, protection of ownership rights, and enforcement of contract law are completely necessary to the functioning of a capitalist economy, whether it's a socialist capitalist economy like Sweden, or whether it's more of a free market economy. If you aren't convinced that your factory that you built today will still be yours tomorrow, then you're not going to build it. You're not going to invest your capital. So they're absolutely necessary. And that's one thing that I think I came away from 2020 with a big question mark there. So what does the incoming administration mean for the economy? We've already seen some stimulus. We've heard noises about more. Hopefully that will be successful. I think that I'm in Dr. Yellen's camp about we need to go really big on the stimulus and make it up later. And that's terrible. We're not going to say that to our clients, but as we mentioned in our last quarterly presentation, or one of our monthly letters, the government has a perpetual timeline, and we are able to make up the difference. And our job right now is to keep people in their houses, try to get people back in their jobs. And so I'm hopeful that even with the extremely divided legislature and political climate, that we'll be able to continue offering some stimulus to support businesses and employers. I also want to call attention to the sort of tone that you can see being set by the cabinet and other appointments that the administration is making. These are very labor and consumer friendly appointments. So I think that's the one thing we can expect to see more of in 2021. And I couldn't resist this picture, because when I was watching the inauguration and I heard the booming, dignified voice say, "the second gentleman of the United States," I just got shivers. It's like, oh, that sounds so fancy. Very exciting times. So our two favorite measures of economic performance are output and labor. So output, in this case, I'm measuring with gross domestic product, which is what the National Bureau of Economic Research looks at when they declare whether we are in a recession or leaving a recession. And a recession, in this case, is defined as 2 consecutive quarters of declining economic output. Every recession in the past has been declared at least, I believe, after the second quarter of declining output, but certainly not during the first quarter of declining output. And this one was such a doozy that, in fact, the NBER broke with that streak and declared it right pretty early on. It may or may not be a double dip recession. So you can see right at the very end of this graph that it turned back upward again. But what we need is to have 2 consecutive quarters of rising output in order to declare that we have exited the recession. And so again, whether we managed to aggressively take care of the pandemic, aggressively vaccinate, mask, and do other measures to help people reduce the surge that we find ourselves in, and how we do with our economic stimulus will help determine whether we see ourselves turn back down again. The other big measure of economic performance is labor, keeping people employed. So in one of our earlier letters, we said that the economy is made out of people and resources, and the labor is one of the measures of the people, and the other one is spending. So the civilian unemployment rate spiked in 2020. That's not news to anybody on this call. I want to dive into the composition of that employment picture a little more. Because it's very different depending, as I said earlier, it's different depending on your perspective and where you're standing. So in this chart, first of all, I want to point out that it's sort of the upside down of the chart we were just seeing. So we saw a spike in the previous chart of unemployment. This is employment by industry. And if you take a look at the left, the top two lines started out at just over 15 million people employed. The top one is construction. I'm sorry, the top one is education and health services. And then the one that kind of doodles along more flat is retail trade. The next one down is leisure and hospitality. So I've got these in there to sort of draw the attention, and then a couple at the bottom just to draw the point that they didn't suffer much of a downturn. So leisure and hospitality was one of the most quickly growing sectors of employment entering the pandemic. It experienced the greatest downturn in employment, and it is not only has it not recovered all of that employment, but it has turned downwards again. So again, like, are you a nurse? You've probably been pretty employed in the past year. Are you a flight attendant? My daughter's Girl Scout troop leader has taken a voluntary furlough of being a flight attendant for an entire year. Very different perspectives. All right, now we're back to the unemployment graph. So this one's more like the first one that we saw. And this one is divided up by how much education the worker has. So we talked about the K-shaped recovery. So looking at the letter K, the upper portion of the K is sort of we're recovering, we're continuing to march along as we were. And that is a lot of our clients, but not all of them, where we had a relatively high paying job, probably not in the service sector, and we have a bachelor's degree or higher. And for the most part, a lot of these jobs people were able to take to working from home. If you're the CEO of a small hotel chain, maybe being able to work from home didn't help, but a lot of people were able to adapt. And not only did they maintain their employment, but we're not spending money on travel, we're not spending money on walking around the mall, we're not spending money on eating out. We might be spending a little bit more money on takeout, but it's really been an interesting reset for people's budgets this year. So that's, again, very different perspective to if you look at the bottom line. I'm sorry, the bottom line is bachelor's degree and higher. So they we had the lowest unemployment to begin with. We have the lowest spike, the most mild spike in unemployment, and we have the unemployment has gone back down, not quite to where we entered the pandemic, but it's getting there. And then at the very top, we see less than a high school diploma. These are folks often in the service industry or in sort of construction labor sometimes. They not only have the highest spike, but that unemployment rate has turned back upwards again. This is something I think we will see the incoming administration try to address, perhaps in the structure of the loans, perhaps in the structure of unemployment support and stipends. It's difficult to guess. There's a lot of ways to try to fix that. Lastly, and I apologize for how busy this graph is, but this is the duration of unemployment. So this green line, that's the tallest lump after the 2008 financial crisis, is the longest unemployed. These are people who've been unemployed for at least half a year. And you'll see that it got up to pretty dramatically high after the 2008 financial crisis. It took quite a while to taper down. whereas these other shorter periods, they didn't spike as these people got back to work sooner. That's what this basically is trying to say. So here we have unemployment in the COVID crisis. It spikes. A lot of people got kind of straight back to work. So less than 5 weeks, 5 to 14 weeks. These folks got back to work pretty quickly. These folks were unemployed for half a year or less. But here we have this troubling 27 weeks and over. And what we're seeing here, first of all, is that it's barely leveling off. It hasn't turned downwards yet. And second of all, it's a pretty big number. We haven't seen this since the early teens. And one problem you have with long-term unemployment is obviously it can be very psychologically and financially damaging to a family. It's also causes what economists call attrition of skill. So these are folks who are not continuing to learn the new piece of machinery that their factory purchased or the latest piece of software that their employer's using. So we start to see that the longer you're unemployed, the more difficult it is to re-enter employment. And that's a kind of more dangerous number. All right, done pounding on employment for the moment. This is a fun graph for an economics nerd. That being said, interest rates are rising is a true statement. Also, the federal funds rate, the Federal Reserve is holding the Fed funds rate near zero and has declared that they will do so for as long as it takes. They're not going to raise interest rates anytime soon. How are these two things true at the same time? So basically, when I say interest rates are rising, I'm talking about these longer term interest rates. This is the US Treasury bond and bond bill note curve. And you can see here that this orange line is the beginning of the year, and this blue line is just even 2 weeks later, the blue line with the diamonds on it, and in fact, yields are rising. The 10-year Treasury rate had never, the 10-year Treasury yield, so how much interest I'm going to get paid based on buying a 10-year Treasury note on the open market, that number had never been below 1% until 2020. So that was a remarkably low yield and also very psychologically important to traders, which, I mean, you've got your economists over here saying there should be no psychological importance, should be no economic importance to crossing that line, but it does affect sort of the mood of the market and how traders behave and investors. We are now back above that 1% number. These are still very low, historically speaking, and that's relevant to individual investors, not just in how much yield we can get on a bond portfolio, but it also informs things like mortgage rates. If you needed a longer term loan for your business, it's a cheap time to borrow if you're confident you can repay it. This on the top is entering, this is at the end of 2006, so we're the 2008 financial crisis is looming, and all things being equal, I should demand that you pay me more interest for a longer term loan because I'm going to have to do without my money for longer, and there's a higher probability in the meantime that your circumstances change and you become unable to pay me back. That's less true of the Treasury curve, but that opportunity cost of lending the money should be a positive number. And when you see this yield curve be what's called inverted, so the shorter term treasuries are paying a higher interest rate than the longer term treasuries, what that means is that traders and investors are saying, I think interest rates will be lower in 5, 7, 10 years than they are now. So I'm willing to pay you less I'm saying it backwards.
To make less.
I'm not willing to pay the bank as much as I would for the convenience of getting my money back. I'm inverting it, but my point is, if I think interest rates are going to be lower in the future, I don't want to be trapped into paying this higher interest rate for that long if I'm the borrower. So that's what this curve means. And the significance of that is that they have pretty much always been followed by a recession. It's not causal. The lower long-term interest rates are not causing the recession. They're an indicator that traders think there's a recession coming.
So what you're saying, Suzanne, is like right now, it's not showing a sign of of a recession coming.
That's correct. It
Right.
does stay pretty cheap for a long time.
Mhm.
So those markets are saying, well, we believe the Federal Reserve. We think they're going to keep rates really low for quite some time, but we also think that the economy is going to get out of this, and in the longer term, things are going to turn upwards. So it's
Yeah.
almost like, how do I think things are going to go?
And of course, these rates, I mean, they really do impact like our work and our projections with clients. I mean, if you're only getting 1% on like a 10-year, treasury, it kind of changes your projections for retirement income, for example.
Absolutely.
And if you can't put your emergency fund in a high yield savings account that's making 1 or 2%, well, you might not want to have such a large emergency fund. There are just a lot of things that understanding these, it does impact individual financial plans as well.
Absolutely. And one thing to think about with that emergency plan example, or emergency fund example, is it becomes very tempting to put those into riskier assets to get a better yield. And but an emergency fund needs to be completely liquid. It
Yeah.
needs to, a dollar today needs to be worth a dollar tomorrow in an emergency fund. So that's something to watch out for. This is where I start to wander a little too far into monetary theory. So if anybody needs to refill their coffee cup, this is a slide to do it. But that being
Okay.
said, I'm sorry, I can't resist it. I have heard a couple of grumpy statements that all of this economic stimulus is going to cause inflation. Is that true? Probably not. A couple of reasons. One, there's currently excess capacity in production in our economy. What does that mean? If we were at full capacity, everybody has a job, they have as much employment as they want or can handle, all the machines are running 24 hours a day. We just can't make one more bicycle by saying, okay, I'm going to hire one more person. I'm going to run my machine 1 hour longer. We can't do it. We're making all the bicycles we can make. Then if you start throwing money into the economy, there's the same number of bicycles to buy, more people with cash in their pockets saying, I think I'll go buy a bicycle, more people saying, you can't, you're having a hard time filling this job. I want more money per hour. These are not bad things, but they are going to raise prices. Right now, we've got a bunch of graphs telling us we have a lot of people unemployed, and we're not producing as much on that GDP graph as we were capable of doing a year ago. So if we throw more money at the economy, it's unlikely to raise prices. And it's that rise in prices is literally the definition of inflation. So that's not necessarily going to reduce the cost of the value of the dollar. That being said, there are a lot of factors that affect the value of a currency. So just because the stimulus is unlikely to cause inflation, I'm not promising that the value of the dollar will be the same in 6 months as it is today. All right, hope everybody refilled their coffee. And now we're turning to real estate. And this is an interesting area. It's a personal interest of mine following real estate. It's also extremely relevant to our clients. Like, real estate is one of the largest investments that most of us will make, buying a home, or some of us are also landlords. And keeping an eye on this market is
It's
helpful
a
as well.
huge source of activity and projects for us right now as well.
Yes,
So
a lot of
everybody's
analysis.
moving, they're upgrading, they're
Yeah, they're
downsizing, they're refinancing.
refinancing.
Yeah. So
Mhm.
if anyone has a question about that, we talk about it all day long. So
We
go
do
on.
talk about
But
it a
go
lot,
on.
and we like it. And actually, if I recall, we've come up with some fun new tools that we're using
Yeah.
to help people with looking at refinancing analysis. One thing I want to call attention to is that part of the COVID support has been forbearance on foreclosures and evictions, giving people the opportunity to not pay their mortgage or their rent for a period of time without being foreclosed on or kicked out of their apartment because of the economic situation. So this has been extremely helpful. We were already at a very low housing supply, and a lot of people had housing insecurity, and we do have some unfortunate levels of homelessness. So preventing additional homelessness is important. And what I want to know, and what we'll see hopefully coming out of our administration going forward, is how do we help these people once that forbearance is going to end? So a lot of the mortgages, this is something that is absolutely lender by lender and perhaps loan by loan. But a lot of them have said, we're just going to take those payments you needed to skip. We're going to stick them at the end of your loan. Your interest rate's going to stay the same. And no
No
harm, no foul.
paperwork, no fee. I mean,
It's been
it's
kind of nice.
pretty, yeah, it's pretty good.
It's pretty
So,
good. And it's in the bank's interest too, because they would much rather like wait a couple more months for their money than have to foreclose on your home and then figure out how to sell it. And it makes a big mess. Now, renters is a little different because I haven't signed a 30-year contract to rent this house. I've just promised to pay a certain amount a month. And if the government is currently preventing me from being evicted if I don't pay it, that helps this month. But what's going to happen when that period ends and all of that rent comes due? If there isn't some sort of arrangement to allow me time, if I didn't have the rent during those 6 months, I'm unlikely to have accumulated 6 months of rent all of a sudden at the end. So that's something that I think is going to need addressing and soon. And further, a lot of landlord, there is a lot of large corporate landlord management of properties, but there's also a lot of little mom and pop, like we upgraded into a larger home and we were able to rent out the smaller one, and those people, they need the mortgage forbearance, and then we wind up with this big circle. So how that gets sorted out as we exit the crisis will be very telling as to whether we wind up with an even worse housing crisis than we had. So pending home sales just bounced right back after we shut them down briefly in the early spring, and then pretty soon people realized, hey, this isn't a 1 month problem. This is a 12 to 18-month problem. I was willing to delay moving a month. I'm not willing to delay moving a year. I got to figure this out. Realtors figured out how to show houses safely. We kind of went right back where we started. And it was really quite remarkable and showed a lot of resilience. Home prices did not move an inch during that downturn. So look again at that temporary downturn in pending home sales in 2020, and then look here at the S&P Case-Shiller National Home Price Index. This is 20 municipal areas in the United States, so it doesn't capture rural housing. But that being said, these prices just kept roaring right up, and this sort of flatter area, the seasonality, that didn't even happen that much in 2020. So that's really very interesting, and it seems totally unrelated to housing quantity or the sales quantity, which says something about the quantity of available homes, which we addressed in an earlier discussion, I think in the last quarter, about we have very low housing availability and housing affordability. So I don't know, personally, if I had an extra $1 billion to spend and was bored and couldn't be a financial advisor anymore, I might try building houses, but I don't want to advise anybody to start wandering into that. So I don't usually spend a lot of time on commercial real estate. It's not an area that's easy for individual investors to get into, but I have been very curious how the decline in retail and restaurant and leisure, and further the increase in working from home is going to affect commercial real estate. And not surprisingly, we've seen quite a downturn since the pandemic began in the United States. It does appear to have turned back up again. It'll be interesting to see how that continues as time goes on. This is just a price index, not a quantity index. So that's something, it could be just fewer sales happening, and that's part of why it's recovering. It's an interesting question. And then what we're seeing is this was a longer term trend, a secular trend of retail moving not just online, but sort of out of malls more than it's moving out of little shops. So malls have been a declining share of total retail for quite some time. And then we see a more dramatic downturn there the beginning of 2020. I wanted to share a picture to sort of drive home my point of a longer term trend of moving away from malls. And I asked my colleagues, hey, what's a movie that I could take a still from that says hanging out at the mall in the 80s? And one of Sarah's suggestions was Fast Times at Ridgemont High. And so I found this shot on a website that is dedicated to telling people where the real life location is that individual movies were shot. And this is that Fast Times at Ridgemont High shot. And the mall it was filmed in has since been taken down and replaced, which really underscored my point of, and I'm not dragging us into it today, but I found an interesting case study on what we're going to do with those malls, because for the most part, they're in more suburban areas where there's a little bit less demand for the land, and it's probably not cost effective to tear the entire building down. So then what do you do with it? Some of it's turning into office space. It's kind of an interesting question. So these are
community colleges too.
Oh, neat. Yeah, I feel like these are things that people have built that are made out of resources that are usable. We should do something with them, but I sure as heck don't want to go shop in the mall. So it's an interesting question. So these are trends that we've talked about that some of them are not so much a change in direction, they're a change in speed, that the pandemic accelerated things we were already seeing, and both in terms of labor and the economic bifurcation and political bifurcation of the country, but also some other things like the move to online retail, teleworking. One interesting question I am keeping an eye on is what airline travel is going to do. I don't feel like business travel is going to go back where it was. Now, people said that after 9/11, and it did recover eventually. So it seems to be a very resilient industry, and the desire of humans to move around seems to be fairly strong. So that'll be an interesting thing to keep an eye on going forward. All right, those are my economic comments. And here we have beginning our discussion of financial markets. And we find a gentleman from the Brokers with Hands on Their Faces blog, which is a great diversion if you need a moment of giggling. And I
Suzanne,
think
can we just,
yeah,
thank
it's
you.
a good one. Some of the blogs
Freeze frame that one, yeah.
freeze frame that. The other thing you'll see a lot of is this, like they're clearly, their bet is not going well. So we think he's trying to figure out what stock markets are going to do next. And so we dove a little bit into, okay, how can we help him answer that question? Before I get into that, and people are going to get sick of hearing me say this, but I think it's really important to remind everyone that investable markets are a small portion of the total global economy. So we've got the investable market bubble, and these are not intended to be to scale. Inside the total market bubble, so there's equities that, for example, that maybe the founding family still holds 80% of the equity of the company, so it's not, only 20% is considered investable. And that's inside a bubble that includes companies that are not publicly traded. There's some biggies in there. One example I found when I was looking for point examples here was Huawei. I hadn't realized it was privately held. That's a pretty big company. So here is what happened in 2020. And I apologize that this is not double coded. So if you don't see colors well, this could be tricky. But what we'll do is we'll look down the right-hand side where the year ended. And I'll tell you from the top down what we're seeing. So this is the Russell 3000 index. And that's a United States all cap equity index. So all different sizes of companies. The next one is my most favorite, really broadly used index, the S&P 500. I like it better than the Dow because the Dow is 30 companies. The S&P 500 is 500 companies. So I think it's a better representation of the market broadly. And then the third one that ends up pretty high there is the all country, meaning both developed and emerging markets, equity index. And that's a large cap index. And that's a very popular broad measure of what equity markets did the entire world around, including the United States. And then the two lines below it, the purple one on top is US investment grade bonds, the Barclays Aggregate Bond Index, and the one below that is the International Aggregate Bond Index. So you'll notice they had a little, they had a little dip down in the spring, but not nearly so dramatic as equities. And but then they didn't offer as much return for the year. And that's pretty much what we expect out of the difference between equities and bonds. It's not always this stark in 1 year as this graph shows, but it is about what we expect out of these asset classes. All right, so we're going to help the gentleman with his hand on his face try to figure out what markets are going to do. So how are we going to do that? Volatility is something I've been told over and over. Oh, look at the VIX, see what the VIX is doing. So the VIX is an index that takes stock option prices. So these are derivatives that people can use to bet on the direction of equity movements, individual equities and equity indexes, and even it gets weirder from there. And you take the price that those are selling at and the price that the underlying instrument, so in this case, the S&P 500 is selling at, and you can back out what that price says about what traders think is going to be the volatility of that index. How much up and down are we going to see in that index in the next 20 days if it's a 1 month contract? Do they tell you what returns are going to do? They do not. I did find a study demonstrating that they are a good predictor of volatility for the next 20 days. we're long-term investors. Knowing that the market will or will not be more volatile in the next 20 days is not particularly useful information, except maybe telling us maybe don't look for the next 20 days if you have a nervous stomach. So zooming in on right now, what this is saying, this is just a close-up on the previous slide of the most recent year of data. Basically, barring surprises like COVID, because here you see there's this huge spike in volatility as you have this downturn in stocks. So barring some sort of shock like that, option traders currently think that volatility in the S&P 500 will be relatively low. And my point here is that and $6 will get you a cup of coffee. It's not a very useful or actionable piece of information for a long-term investor. Okay, what about fund flows? This is money going into or out of equity funds, being stock funds that are mutual funds or exchange traded funds. And so that's the right-hand side, and 0 means all the money's in net, all the money's staying put. And obviously a positive number would mean more money is going into those funds. A negative money number means money's coming out of those funds. It is a valuable indicator of how investors are feeling about the market, and it is a fairly useless indicator about what the market's actually going to do. Now, that being said, with a caveat, there's sort of money on the sidelines is an idea that we've heard before. Basically, if this money all came out just because people were nervous, not because they used it to pay rent or decided to go invest in real estate instead, if it's just cash sitting on the sidelines, there, as we've shown and we'll show later, equity markets are one of the best places you can go for long-term returns. So that's cash waiting on the sidelines. Arguably, as it comes back in, whenever they decide to be less nervous and bring it back, all other things being equal, would drive equity prices up. That's true in the short term. It's not necessarily a useful piece of information for what long-term investors should do. I don't want to pound this point too hard, so this points out that interest rates are also not a good predictor of stock market returns. I think I've kind of made my point on that one. Here's a pretty quilt that is basically showing us, can we derive any useful trends that we could make bets on industry by industry? Not really. No, that doesn't necessarily mean, obviously I feel more positively about online retail than I do about hydrocarbon extraction. I think we're going to stop extracting oil sometime in my lifetime, and we're probably going to just increase our online purchases, but that doesn't tell me what these different sectors are going to do this year, next year, or even for the next 10 years. What is one thing that I will say is a reasonable predictor of returns? And this isn't absolute returns. I'm not telling you if stocks are going to go up or down, but within the context of what the stocks are going to do, which funds will do better relative to others is best predicted by how much it costs to invest in those funds. The cheaper funds do better very consistently across asset classes. And what's interesting is this has been demonstrated repeatedly. This is an older study, but I wanted to get one specifically from Morningstar because Morningstar did a study of their star ratings, which they're using to try to help investors determine the relative attractiveness of different funds in the same sector. You would think they would want to demonstrate, hey, if you've got a 5-star rating, you're going to perform better than if you've got a 1-star rating. Nope, it wasn't predictive. The thing that was predictive was the cost of the fund. So if Morningstar is running around publishing that, then I think it's a pretty compelling finding. But once again, doesn't tell me whether stocks are going up or down next year. It just tells me what kind of fund I want to be invested in. So the portfolio implications of what I just said are that buying and holding is kind of your best bet. It's in longer term, for a longer term investor. And the point I want to make in this graph is, let's say you bought at the top of the dot-com bubble or the top of the real estate bubble right before the 2008 crash. Even if you got unlucky and put all your money in the market on that day, you would still be ahead today. And that being said, even if you bought at the previous maximum right here at the beginning of 2020, end of 2019, you would still be ahead today. So this is more of a gamble, obviously, than this longer term thing, but time matters more than timing. It's a famous quote in the investment industry. And that's part of why we emphasize long-term investing. So conclusions, as we've said a million times, people probably get tired of hearing me say we need to invest for the long term in a well-diversified and inexpensive to manage portfolio, so low fund fees. We encourage people to use a comprehensive financial plan to squirrel away assets. And we'd love to see everybody wear your mask, stay home, try to put down Twitter before bedtime. Please take good care. Reach out if we can be of any help. I couldn't resist this adorable picture of the baby with the mask on. And that concludes my remarks, and we're ready for questions.
Okay, so do we have any questions for Suzanne? Let's see. My first question from Brendan. What is your opinion on where inflation is going, and how will the increase in government debt affect inflation?
Okay, good. So I think inflation is probably not going to spike up on us dramatically if we do manage to increase the minimum wage, especially if we manage to do so in a brief period of time. That necessarily raises prices. Labor is one of the prices that is an input into production. So it takes people to make the widgets that you're going to buy. If the cost of labor just went up by 50%, or 100%, depending on the national minimum wage is 7 something, and we're talking about a $15 minimum wage. If we were successful in that, you're going to see an increase in the price of that product that labor is producing. You also, however, will see substitution effects. So if I'm a widget factory owner, I'll say, okay, my labor just increased, the cost of my labor just increased 100%. What am I going to do? Well, let's see if I can figure out how to have one worker run 2 machines. And I'll go talk to if I'm smart, I'll go ask my workers how to do that and figure it out. And we'll have those substitution effects in the long term. But in the short term, we would see that increase. Brendan was asking, the increase in government borrowing, does that cause inflation? We need to see government borrowing interest rates rise significantly before we would see. So if we think of interest rates as the price of a dollar, what does it cost? What are dollars cheap or expensive? One of the ways to look at that is interest rates. So if the government kept borrowing more money and everybody's like, well, if you want another dollar, I'm going to charge you more to borrow it. And as interest rates start rising, that means the value of the dollar is going to start relative to other currency. No, but it doesn't work. So this is the part where I can just hear Dr. Willett in his strange Minnesota, Virginia accent yelling at me in graduate school, because he'd say, okay, we're going to increase debt and we're going to hold exchange rates constants. What are interest rates going to do? And I would guess, and it's 50-50 chance. And I felt like I always got it wrong. But there's so many factors go into the price of the dollar that it's not as simple as saying inflation's going to go up. And at the same time, like, iPhones become twice as powerful for the same price every X years. It's something where it's very difficult to say that aggregate prices are going to, what aggregate prices are going to do. It's even harder to say what specific prices are going to do. The level of government borrowing, if I thought it was going to be sustained for a decade, I would be more worried about that. But we had a chart last quarter that is probably up on our blog, but I can share it in a future discussion. Basically showed government borrowing and government deficit over the years and how it goes up and down, but the borrowing is kind of just marches right along with the price of the dollar, and it's not something that that has a long-term dramatic effect. I don't know if I've answered Brandon's question. I think I wound up in another one of my monetary finance.
I was thinking
spirals.
though that could be like maybe a theme of like a future presentation, because I have seen, those charts of like, okay, well, what about government debt? Like, are we going to pay that back? And so, I've seen like, depending on the economy and other factors of like, okay, in certain administrations, whatever, it's, it goes down, it goes up. But what is like the current trend? Well, it's been going up, the government debt. So how does that impact in inflation and other things?
Well, and another thing to keep in mind is that the more that the government is spending on interest, the less, without raising taxes or without increasing GDP on which they're taxing without increasing the base on which we're getting the taxes, then that means that's one less dollar to spend on education or military bases or whatever it is else that we might be spending it on. So it does kind of squeeze out some of the government spending.
Okay. I think it's a complex issue. I think,
Yeah.
I think,
Yeah, it's a
I
fair
think,
point.
I think we've talked about it a bit, but I do think it's something that we'll delve deeper on future
Mhm.
calls.
Yeah.
Um, okay. And, um, any other follow-up questions?
I see one Q&A here.
Yeah, I think that's
Oh, wow.
the same one. Yeah. Um, the, Just the other thought, I thought the real estate slide was like really interesting about how the prices kept going up, and also, we got the you said got right back on the bicycle, so, so it was like a quick recovery in terms of sales. Of course, all real estate is local, and
Yeah.
certain markets like such as New York City, where a lot of our clients are based, where didn't have that experience. Um, but it's interesting, to look at nationwide, or I think that chart shows so many metropolitan areas.
Mhm.
Yeah. Okay. And then we also have another question on any thoughts on whether there will be a reset on the rate at which college tuitions are rising due to COVID/slash e-learning.
That is a great question. I think that what we're going to see first, and to my way of thinking, this is unfortunate, but it's just a normal economic phenomenon. We're going to see a lot of colleges closing,
Yeah.
um, which makes me sad to think of, well, if my alma mater closed, I would be heartbroken. But that being said, education as a service, people are paying money for that service. The inflation rate, as Kelly alludes to, on the price of that service has been insane for years. To go to the college that I went to, that I graduated from in 1995, cost 2.5 times what it did when I went there. Um,
Yeah. I mean, I would say the answer to her question is yes.
yeah,
There will be a reset because I think there's a huge backlash. That the prices of education has been rising much faster than the rise in inflation for the last, few decades, really.
yeah,
Um,
absolutely.
and in COVID, a lot of college students who, didn't done the e-learning are saying this is not worth like 40, $50,000 a year. Like I
Right.
could have just, taken like an online course and been fine. So I
Yeah,
do think there's going to be a reset. And then also to your point, Suzanne, saw a really interesting study looking categorizing all the colleges in the US and looking at like reputation and their endowment, and
mhm,
also like their exclusivity, like how many students that applied they actually accept. And so like a Harvard, they have a huge endowment. There's
yeah,
huge demand, like kids are always going to want to go there. They're not in trouble. But like certain colleges, like smaller liberal arts school that maybe like don't have like a large endowment, like some of those schools are in like financial trouble. And maybe in the last decade, they've invested a lot of money in things like new dorms or whatever to try and attract students. Well, now they're foreign students that were paying like the full price are not coming back. And, some of those schools are really in trouble. And so,
yeah,
I do think that there will be a little bit of a shakeup in some of those schools
right,
closing,
right.
which is a loss. Um,
Yeah, so it's not so much that we'll see those schools lower tuition prices, it's that we'll see consumers or students moving from the higher cost experience-based, residential-based colleges to like, okay, you know what, I could live at home and continue to work part-time and do the local community college online. So that demand will move over and we'll lose some
Yeah,
of those
not
kinds
even
of people.
local community college, but I mean, like big schools are offering like online, certifications and degrees and things
Absolutely.
too.
Yeah,
So it's definitely an interesting industry to watch right now.
yeah.
All right, so we have another question from Beck. And she asks, are you seeing changes in client career and retirement plans due to the impact of COVID? For example, more likely to change jobs, pushing out retirement, retiring earlier, etc.
Yeah.
And
So I
again,
think we're
yes.
seeing that. Yeah, we're totally seeing that change. And Sarah, I can probably speak better as to our actual client base, but what we're seeing broadly nationally is those changes are absolutely happening. Like whether you can afford to retire soon, maybe you realize I really like working from home. I think I'll just go ahead. I don't want to, be a dental hygienist anymore. I'm going to figure out what I can do from home. So we are seeing some shifts and some opportunities. Some whether they seem to the individual to be positive or scary is kind of again it's that matter of perspective. But nationally speaking, I think we're definitely seeing a shift. What do you think, Sarah? Is our clients
I mean,
broadly
huge
experiencing it?
shifts. Like some people, people who were like maybe close to retirement and thought they would like ride out this job into, their
Mhm.
into the sunset, and they lost their job and are, kind of thinking like, well, I guess I'll retire earlier. Actually, I'm surprised you didn't mention Suzanne because another big trend is women, who are
Oh, yeah.
moms leaving the workforce because they just couldn't, manage like home and believe me, it's a lot. Like homeschooling plus working from home and all those
Yeah,
things. And so taking some
absolutely.
time off. And so, that's like another way of looking at like, okay, that is a change in someone's career plan. if
Yeah,
if they're, deciding to like maybe leave the workforce for a while or switch jobs to something they could do from home,
yeah,
or switch to part-time, so
yeah,
and so forth.
absolutely.
So there's um, definitely a lot of that happening. And frankly, another thing I will add is that, a lot of people have really been affected by this and, seeing people that they love, die before their time. And, I do think that there are people who are like, you know what? Like, I need to, do what makes me happy. And,
Absolutely.
that's the most important thing and not necessarily, the rat race, the grind, whatever you want to call it.
Right.
So,
Absolutely.
yeah, so I think that the past year has led a lot of people to, reassess their life plan, and that is something that we have a lot of, really fascinating conversations with our clients,
Yeah, we
um,
do. And it's a
on those
great time to reach
topics.
out to your financial planner because it sort of becomes a question of, okay, do I get to retire early or do I need to go find another job?
Yeah, yeah, and of course we see it that way, but but that's how we are.
It's our
So
sampling error.
I think that's a good note to end on. So, and that was the last question we have right now. So let's end it there. I just want to say thank you for everyone who came in person. We did, but if you didn't, we're recording this. We're going to be posting it on the blog, and I'm really enjoying these and looking forward to doing this every quarter with you, Suzanne.
Yeah, I'll try to stay out of the monetary theory quite so much.
All
Try and
right.
keep people away.
All righty, everybody. Thank you.
Thank
And I'm going to
you.
close it out. All right. Bye bye.
Bye.